Imagine standing in the middle of a $100 billion city. The skyscrapers are gleaming, the malls are massive, and the infrastructure looks like it's from the year 2050. But there's one problem: the streets are empty. The lights in the apartments never turn on. And the developer who built this dream just defaulted on a billion-dollar loan. For 30 years, we were told that China was the unstoppable locomotive of the global economy. We were told that the 21st century belonged to Beijing. But as we sit here in 2026, the cracks aren't just visible anymore, the entire foundation is splintering. From the collapse of the shadow banking system to a population that is shrinking faster than any nation in modern history, China is facing a perfect storm that no amount of government stimulus can fix. Today, we're going beyond the propaganda and the headlines. We are looking at the cold, hard numbers of why China's economy is officially breaking in 2026, and more importantly, why this is a massive warning sign for your own wallet here in the West. To understand why 2026 is the breaking point, we have to look at what built China in the first place: brick and mortar. For decades, China's GDP was fueled by a real estate obsession. Nearly 30% of their entire economy was tied to building apartments. In the US, your home is an asset. In China, it was a religion. People put 70% of their life savings into pre-sale apartments that hadn't even been built yet. But in 2026, the music has finally stopped. We saw the tremors with Evergrande and Country Garden years ago, but now the contagion has hit the local government levels. You see, Chinese cities didn't fund themselves with taxes like New York or London. They funded themselves by selling land to developers. Now that the developers are broke, the cities are broke. We are seeing social credit systems being used to stop people from protesting outside banks. When the very thing that makes up 70% of a citizen's wealth loses 40% of its value overnight, you don't just have an economic crisis, you have a social time bomb. Now let's talk about the one thing the Chinese Communist Party, CCP, cannot print money to fix: people. 2026 marks a terrifying milestone in China's demographics. The one-child policy wasn't just a social experiment. It was a slow-motion economic suicide note. Today, China's workforce is shrinking by millions of people every single year. Think about the math. An economy needs young people to consume, to innovate, and to pay for the pensions of the elderly. But in China, the youth unemployment rate has become so sensitive that the government literally stopped publishing the data for a while. We are seeing a generation called the full-time children, young adults with university degrees who are being paid by their parents to stay home because there are no high-paying jobs in the tech or finance sectors anymore. When you have an aging population and no young workers to support them, your economic miracle turns into an economic graveyard very quickly. As we move through 2026, there's a new player in the room: artificial intelligence. You've probably seen the headlines about DeepSeek and China's massive push into AI. On the surface, it looks like they are winning the tech war. But if you look deeper, it's a desperate move. China is trying to automate its way out of a labor shortage. However, the US-led chip sanctions are finally drawing blood. Without high-end NVIDIA H100s or the next generation of Blackwell chips, China's AI ambitions are hitting a hardware wall. They can build the best software models in the world, but if they can't get the silicon to run them at scale, they are stuck in the past. This tech isolation is creating a two-tiered world, and for the first time in 40 years, China is on the outside looking in. They are spending billions on self-reliance. But you can't reinvent 50 years of semiconductor history in a single 5-year plan. If you want to find the black swan of 2026, look at the LGFV's local government financing vehicles. This is the shadow debt that kept the lights on in rural China. Conservative estimates put this debt at over $9 trillion. To put that in perspective, that's nearly half of China's entire GDP hidden in off-balance sheet accounts. In 2026, these local governments are running out of ways to roll over this debt. We're starting to see reports of civil servants not getting paid, bus services being cut in major cities, and even streetlights being turned off to save cash. This isn't just a recession. It's the bankruptcy of a system that was built on the assumption that growth would never end. When the growth stops, the debt remains, and the bill is finally coming due. But here's the real question that everyone in the USA needs to be asking. If China goes down, does it take the rest of the world with it? Is this the moment where the US dollar becomes stronger than ever? Or are we looking at a global contagion that will trigger a 2008-style meltdown across the Atlantic? In the second half of this breakdown, we're going to look at the Taiwan factor, the secret gold hoarding happening in Beijing, and exactly what you should do with your portfolio to survive the great 2026 reset. When a superpower's economy starts to rot from the inside, history tells us they often look for a distraction on the outside. As we move through 2026, the rhetoric around Taiwan isn't just political anymore, it's an economic strategy. If the CCP can't give its people the Chinese dream of wealth and property, they might try to give them national glory. But here's the reality that mainstream media often misses. An invasion of Taiwan in 2026 wouldn't just be a military conflict. It would be the final nail in the coffin for the global supply chain. We're talking about 90% of the world's most advanced semiconductors. If those factories go dark, your iPhone, your Tesla, and the AI servers running Wall Street stop working. Bloomberg estimates a $10 trillion hit to the global GDP. For China, it's a suicide mission. They are already struggling with a trade surplus that the US is actively trying to cut down. A war would mean total isolation, and in 2026, China is too dependent on imported food and energy to survive a total blockade. The Taiwan factor is the ultimate wild card that keeps every hedge fund manager in New York awake at night. While the world is distracted by the property crash, something very quiet and very expensive is happening in the vaults of the People's Bank of China. For 14 consecutive months leading into 2026, China has been on a gold buying spree. They aren't just buying gold. They are dumping U.S. treasuries at a record pace. Why? Because they've seen what happened to Russia's dollar reserves. China is trying to sanction-proof their economy. They are building a fortress balance sheet so that if the 2026 economic war turns into a real war, they can still trade with the global south using a gold-backed yuan or a digital currency. This is the de-dollarization narrative on steroids. If you're an investor in the US, you need to realize that the era of China being the reliable buyer of American debt is over. This means higher interest rates for longer in the US because the biggest customer just walked out of the store. If you listen to the 15th five-year plan, 2026 to 2030, coming out of Beijing, they have a new buzzword: new quality productive forces. This is Xi Jinping's big bet. Since they can't grow through building apartments anymore, they are going all in on high-end manufacturing, green tech, and AI. In 2026, China is flooding the world with cheap electric vehicles, EVs, and solar panels. They are trying to export their way out of a domestic recession. But this is where the friction with the USA reaches a boiling point. The US and the EU are slapping 100% tariffs on these goods to protect their own industries. This creates a global glut, too much stuff and not enough people with money to buy it. This is the definition of deflation, and it's the most contagious economic disease in the world. China is effectively trying to export its poverty to the rest of the world, and in 2026 the world is saying no. The most human part of this story is happening on the ground in cities like Shenzhen and Shanghai. In 2026, the social credit system is no longer just about catching jaywalkers. It's being used to manage the economic fallout. We are seeing reports of financial frozen zones, where people can't withdraw their money if they have participated in protests against local banks. The social contract in China was simple: give up your political freedom in exchange for getting rich. In 2026, that contract is being torn up. When the youth can't find jobs and the elderly are seeing their pensions being cut to pay off local government debt, the internal pressure becomes immense. This is why the CCP is tightening its grip on the internet, and AI. They are terrified of a 2026 spring, where the people finally say enough is enough. So what does this mean for you? If you're sitting in the US watching your 401k, you cannot ignore China. Diversify away from China-heavy tech. If a company gets 30% of its revenue from the Chinese consumer, 2026 is going to be a rough year for them. Watch the gold price. China's buying floor is keeping gold at all-time highs, $4,500 per ounce. It's no longer a speculative asset, it's a survival asset. The rise of India and Vietnam. The China Plus One strategy is in full swing. The money leaving China has to go somewhere. And 2026 is the year these emerging markets finally take the lead. The breaking of China's economy in 2026 isn't a single event, it's a slow-motion train wreck that has been decades in the making. It's the story of a nation that tried to grow forever on a foundation of debt and concrete. only to realize that you can't cheat the laws of economics. As the finance historian, my job is to remind you that every empire thinks it's invincible right until the moment it isn't. China isn't going to disappear, but the China we knew, the one that fueled global growth for 40 years, is officially broken. The question is, are you ready for the world that comes next?